Donald Trump is back in the spotlight, making bold claims about what he calls the biggest wealth shift in history. You might be wondering, could he be hinting at the rise of digital assets? That's what we're diving into today. And don't worry, we're not stopping there. We've also got insights straight from the top. Goldman Sachs global head of digital assets shares some eye-opening perspectives on the next big shakeup in the financial world and which assets could be in the crosshairs. Plus, there's fresh news from Flare, XRP, Robinhood, and a bunch of other major players. Buckle up, this is going to be packed. Kicking things off with Trump, he recently celebrated some landmark trade breakthroughs, one with the UK and another with China. Both are being hailed as major wins. While the UK deal is finalized, the China agreement still has a few details to hammer out, but Trump's optimistic. He mentioned that China has agreed to open up trade in a big way, but as always, the proof will be in the follow-through. Still, the talks went well, and it looks like there's real momentum building. There's a ton going on, more than we can unpack in one go, but one of the big headlines is that tensions between the US and China seem to be cooling off. Both sides have made major tariff cuts. The US slashed its tariff rate on Chinese imports from 145% down to 30%, and China dropped its tariffs on US goods to around 10%. That's a big improvement from where things were, though it's still a bit steeper than the levels Trump had during his first term and even a notch higher, about 11% than under Biden's current policies. So while it's progress, there's still room to go. And here's another big moment. President Trump just put pen to paper on a strategic economic partnership with Saudi Arabia. From the energy sector to defense deals, this alliance could mean serious business. And yeah, it looks like it was quite the celebration. Shifting gears now, let's talk disruption. Matthew D. McDermott, the global head of digital assets at Goldman Sachs, took the stage to weigh in on where blockchain is making the biggest waves in traditional finance. He pointed out that stablecoins, often seen as one of blockchain's most practical applications, could be a real game changer, especially if new regulations clear the way for banks and institutions to use them more easily. If the legal structure allows it, adoption could take off fast. What's more, he highlighted a broader effort underway, a market infrastructure bill that's expected to come into focus later this year. For large financial institutions like Goldman Sachs, having a clear regulatory framework is essential. It's not just about being innovative, it's about making sure that innovation fits within the rules. If that happens, the digital asset space might be about to hit a serious growth spurt. The potential to trade or use stablecoins while also interacting directly with the balance sheet is opening up exciting possibilities. What's really interesting here is how the government seems to be rolling things out in a step-by-step manner, first ensuring permission structures are in place, then gradually expanding their use. It may feel like a slow burn, but both stages are crucial and carry real potential for reshaping how we move money. So why is everyone suddenly so hyped about stablecoins? The reason is actually pretty straightforward. They help support national currencies. Whether we're talking about the US dollar, the British pound, the euro, or even the Swiss franc, every central bank wants its currency to stay strong and widely used. But when fewer people are buying US debt, that spells trouble. Stablecoins offer a clever workaround. They're typically backed by things like US Treasury bonds, which makes them attractive to the government. Scott Bessent pointed out that if major countries like China, Japan, and the UK start offloading American debt, the US will need new buyers to keep things stable. Without that demand, interest rates on bonds could skyrocket, think 5% or 6%, and that could trigger a full-blown crisis for the dollar. That's why officials are keeping a close watch on the bond market and looking at stablecoins as a kind of financial safety valve. Now, shifting focus to how this ties into the bigger picture of finance and banking, this is where it gets really compelling. The main reason institutions are pouring time and money into blockchain and digital assets is because of the resilience it offers. Right now, the way markets function has a lot of rigid cut-off times, but with digital assets you can execute transactions instantly, down to the exact minute. That's a massive advantage, especially for same-day trading and settlement. Another major factor is risk reduction. In today's financial system, especially in collateral-heavy areas, risk is everywhere. But blockchain tech can cut a lot of that out. For example, by using tokenized money market funds or US Treasuries, institutions can allocate collateral in real time at T+0 speeds. Compare that to the traditional T+1 or T+2 pricing windows, and it's clear how much more efficient things could be. That's a big deal, because right now firms have to hold on to large buffers just to hedge against timing risks. Reducing that overhead could be a game changer. And finally, let's not forget about transparency. Looking ahead to the discussions happening at upcoming finance events, there's a noticeable shift in attention toward the buy side, especially private funds and alternative asset groups. People are craving more visibility into how these funds operate. Digital assets and blockchain are primed to deliver exactly that: more clarity, less opacity, and a better way to track where the money flows. This is where things get really exciting. Once you start tokenizing assets and scaling those digital marketplaces, you're opening the door to an entirely new wave of investors. It's not just about ownership anymore, it's about real-time access to data and seamless participation. Imagine getting live market info and even receiving tokenized assets dropped straight to your wallet. Right now, many traditional markets are still stuck in slow, fragmented systems, but this kind of innovation could flip that on its head and make trading far more fluid and accessible. Now picture this: markets that never close. We're used to trading windows that run a few hours a day, 5 days a week. But what happens when trading becomes a 24/7, 365-day experience? Doesn't matter if it's 3 a.m. in New York or noon in Singapore, you can hop on and move assets whenever you want. That kind of non-stop accessibility is going to change the game, and the demand for it might be a lot bigger than we currently think. Case in point, VanEck, a heavyweight in the asset management world, just dropped a tokenized treasury fund. We're talking about a firm with over $120 billion under management. They've rolled out the VanEck Treasury Fund, known as V-Bill, and it's not just sitting on one network. It's already live across Ethereum, Avalanche, Solana, and BNB chain, powered by platforms like Securitize and Wormhole. This isn't theory anymore, it's happening. And with partnerships and integrations popping up all over the place, it's only a matter of time before XRP gets added to the mix. We already see strong connections between XRP and these players. The XRP ledger is now tied in with R.XYZ, and VanEck has shown increasing interest in XRP-backed products. Securitize, who is deeply involved in these new offerings, has worked with Ripple before. They're not strangers. Given the history and ongoing developments, it wouldn't be surprising if XRP becomes part of this tokenized ecosystem very soon. Looking ahead, XRP is gaining traction in major payment infrastructure circles. MasterCard recently acknowledged XRP as a legitimate bridge currency for live transaction systems. That's huge. Over the years, Ripple has built relationships with financial giants like Visa, MasterCard, American Express, and even China's UnionPay. These aren't just pilot programs, they're real-world global integrations shaping how cross-border payments happen. The momentum behind Ripple's USD stablecoin is picking up too. Companies like BKK Forex and iSend are already using it to facilitate faster, cheaper international payments. With fees dropping to mere pennies and settlement speeds measured in seconds, it's a massive improvement over legacy systems. And if this growth continues, we could easily see the stablecoin market balloon to $10 or even $20 trillion over the next couple decades. What's more, if